Welcome to the Finance Geeks, a podcast about real financial planning. Join us as we get into the nitty-gritty, discussing everything from pensions to portfolios. If you're into numbers, strategies, and running a successful practice, this is your ultimate geeky hangout.
Hello and welcome to Season 2, Episode 14 of the Finance Geeks podcast. Thanks for joining us. My name is Warren Shute and I'm here joined by
Paul Cleworth.
And today, Paul and I are talking Trump, tariffs and market volatility. But before we jump into that, Paul, what have you been up to?
Been on holiday. It's the Easter break for my children, and we went to Valencia for 6 days. So I thankfully flew from Heathrow because even though it's 45 minutes away and Luton Airport's 15 minutes away, the whole process, check-in and the parking, everything's easier at Heathrow. So stayed in a flat, an Airbnb, and then did all the sites. Very similar to I suppose Barcelona or even Marseille, which is obviously in France, but it's much bigger than I thought. To be honest. I thought it was going to be a small, cozy town on the coast, and we went to the coast to the beach once. But it's huge. The beach is like Santa Monica, where it's a really long, wide beach, and there's a walkway and some restaurants. And we did the Science Museum and the Biopark, which is like the zoo, and the Oceanographique, which is a big aquarium type place. It was amazing. Cool. It's really, I totally recommend going to Valencia. So, I came back Sunday morning, and we got back in early afternoon. And then after doing a few chores around the house, I watched the final day of the Masters, and I loved it. Did you watch it?
Yeah, no, just watched it. I was on the train, so I was watching bits on the train.
So I normally try to catch the final day, and I've not been into it the last few years, but because Rory McIlroy and Justin Rose were right up there, and I was thinking, I really want him to win the Grand Slam, and I ended up staying up till about 12:30, 1:45, and I knew I was at gym the next morning at 5:15, so it wasn't. I only got 4 hours sleep, but it was probably one of the best sporting moments I've ever witnessed, and it was so exciting. But he made it so difficult and heart wrenching because, of course, he went to a playoff with Justin Rose, and you think he missed a putt for the Grand Slam, and then he won it for the Grand. I was like, thank God he won it. So I was really pleased for him. I think for me, the only two of the moments I can recall in my, that I've seen on TV that I think are the best sporting moments is when Jamie Donaldson in 2010 on the 15th hole of Celtic Manor, he won the Ryder Cup for the Europeans. I enjoyed that golfing episode on TV, and I also loved the 2003 drop kick from Johnny Wilkinson when
I was hoping you were going to say that
England won the World Cup. Yeah. That was those two moments. Besides this one, are probably the best I've ever seen.
Yeah, no, definitely. Yeah, no, it's pretty impressive. So what I did love.
So lastly, I got one more thing. Yes, I've been watching Landman, Billy Bob Thornton and Demi Moore and Ali Larter and John Hamm. It's West Texas oil rigs, that sort of stuff. So would recommend it. I'll put a link to it in the show notes. But that's me. That's me. What have you been up to, Warren? Because I must say, you're looking very well and very smart, by the way.
I never know if you're being sincere or not.
You'll never know.
I've been good. Yeah, I've been good. Life's good. I'm also on holiday. I've come in to do this recording just specially for you because I love you.
I feel honoured.
It's we're off to Portugal on Saturday, so it's my birthday on Friday. And got a week.
What are you, 62, 63?
Yeah. Cheeky monkey. I'm 50.
No, it's 51 this year, isn't
51
it? 51, yeah.
Yeah, big 51. So, been playing a lot of golf. Been out on the golf course quite a lot. Been played every day this week so far, which is pretty good. So,
been getting into the low 90s?
I actually went down around Celtic Man in 86.
You're joking. No. What was for the first 9?
Now, trust me, I'm going back on my birthday. I'll see if I can match it, but I don't think I will. I'm normally a late 90s, early 100s kind of guy. So that was
86. That's really good.
I was playing on my own, so no one believes me. But I track it.
I don't believe that you either.
Watch, but and played yesterday. I just on a local course, played really well. Been watching a lot of coaching videos. I've got one of those Hack Motion apps that help you with your swing and stuff. It's really helped. So, okay. Getting into it. In Portugal, we've got a couple of rounds booked, Ollie and I, which would be great. Playing on the Faudo course, actually. There's a Faudo course out near us, where we're
And are
staying.
you all going? The whole family going, or just you and I?
No, the
And
whole family. Yeah, the four of us are going.
Bella and Nikki as well. Very good.
Yeah. So they'll do their thing, go to the spa, sit around the pool, do whatever, and then Ollie and I will disappear. And we've got one early morning round and then one later afternoon round.
Would you ever get Nikki to caddy for you?
She did say she was going to come the other day. Actually, I went to Celtic, and she was going to come around, drive the buggy around with me. That's what I like at Celtic. I'm a buggy 18-hole player, so I play 18 holes. I do like to go around in a buggy. I enjoy the experience a bit more. In Celtic and Castle Coombe, sorry, is very hilly. So it's I've been doing that and just enjoying the time off. Really, just I was out for breakfast this morning with a friend, and this afternoon I think Nikki's got a few chores for me to do. So it's been all good. It's been all good. So that's me. That's what I've been up to. But hey, news, headlines, everything's going on. Today's topic: Trump, tariffs, and market volatility. Should we switch to the main focal point and discuss that?
We should, because it's obviously pretty prevalent in the press at the moment, isn't it?
It's
prevalent in the press.
Well, you've got to keep abreast of what's going on, not necessarily because you're going to make any changes to your portfolio, but clients are likely to say to you, hey, did you hear this? Did you hear that? And I think I was in a meeting and didn't come out until later on. I'm sure we're going to touch on it when he changed the tariff rates and such like and withdrew them. So lots going on. So where do you want to start with? Because there is literally so much to unpack.
Yeah, there is a lot. I think that I was interested in talking about not just going into the minutiae of what's happened and whether they're a good idea and the logic behind it, or there's absolutely no logic behind them, but the fallout of it, and how it's perceived by clients, because clearly there's been volatility in the stock market. And I think if you're an experienced advisor where you've got clients you've been working with for a long time, if you've been talking about this, if you've been educating them over the years, if you like, in a sort of non-patronizing way, but they've got the experience and you've been reassuring them that this is par for the course, this happens, they will have seen, if they've been with you, some of them 20 years, great financial crisis, what's happening in 2015 with the sort of fall in oil price, and then we had Brexit and all these, Ukraine-Russia war in 2022, and obviously the pandemic 2020. There's been so many things, but in all of that time, generally stock markets have risen, and I think that it's for me, it's all about perspective. I saw the client just yesterday. We had a meeting. The last time we did a formal written face-to-face review was February last year, and it's normally every year, but it was pushed a little bit to April. But he's still just over 3% net up in that period of time. And if you hadn't looked at it at all and the markets at all and just said, "Oh, am I up or down this year?" He's still up. It was up 13% at one point up until a few weeks ago, and of course we've had a market decline. So I'm interested in discussing with you what that means, what volatility means, and how clients perceive it, and what they should perhaps be doing about it.
It's interesting because I look after a very skilled and experienced psychologist, and her mindset and her ability to read people is astounding. It really is. But she's also affected by the market volatility and what's going on. And I had quite a long phone call with, not a long phone call, but I had an in-depth phone call with her just before I broke up. And that was what it was about, just talking to her about, hey, we have these biases and we want to be right. As individuals, we want to be correct. And therefore, when we read things and we remember things that reconfirm the fact that, oh yeah, my views on the world are correct. And she was reading about how the world's going to pot and how this is going wrong and that's going wrong. And that's really what she was believing. And I just had to remind her of these things that she was sort of talking to her clients about, that you have these biases, you get reconfirmation that, hey, if you think things are going wrong, you're certainly going to find that. It's called the reticular activating system part of the brain. It's the part of the brain that will filter out bits of information that are irrelevant. Like when we're talking now and the listeners are listening, they're probably not aware of the pulse in their left ear. They're probably not aware of the temperature of the back of their spine, because there's so many thousands of million things going on in your body. We can't pay attention to everything what's going on all around time. So to save us going crazy, our brain filters out all the stuff that's not important and focuses on the things that is important. And it reconfirms that information. So if we think the world's going crazy and it's going to go bust, what we read in the press will get confirmed by it. So she was adamant that things were going crazy. And I just had to bring her out 30,000 foot and say, hey, look, stop, let's zoom out. Let's have a look. Let's have a breather and just realize and go through these things. And I just remind clients that, hey, look, the stock market is positive 3 years out of every 4. It goes down intra-year, but typically it's going to return around 9% return a year. And when you sort of look back at the logic, I think most people can really understand that, okay. And then their concern is, are they going to have money to spend? That's really the ultimate question. Are they going to run out of money? And when you explain that to them, I think they're a bit better.
Yeah, no, that's really interesting. I think that a lot of the people will be believing now, they'll be asking themselves the question, is this time different? Because you've got this president who's got another 3.5 years left, and we've got this 90-day reprieve from April the 9th, and by July the 8th, they're going to come back in. And what's going to happen? And how has he got these powers to do this? And what is the impact going to be? And I think because you've got this uncertainty of whether they're going to come back in at a high level for different countries, whether all these, apparently it's 70 or 75 countries are going to be at Trump's begging bowl trying to renegotiate their country's trade tariffs with, you don't know what the result is. Normally it takes a couple of years to negotiate a trade deal, and he's trying to do all these countries in 75 days. 90 days, 75 countries in 90 days. And because of this uncertainty, I've had discussions with clients recently where they're saying, well, should I invest more money now? Which is hugely positive, because that means for me, they've thought about it. They realise markets are choppy and that they've dropped recently. And I say, well, yes, if you're going to invest for 5 to 10 years, that's what investing means, or 7 to 10 years plus. Should you put it all in, invest it all today? Maybe, and just it's dropped lower than it was previously. But I have been advising to sort of phase it in over the next 4 months, because it's totally possible that if Congress in the States don't have 2/3 majority to sort of veto these new tariffs, which is what they need. And remember that the House of Senate and Republicans and Representatives is largely Republicans. So it's unlikely in my mind that 2/3 of them will vote to veto it, but it could happen. And there's been a lot of distrust of Trump, a lot of discussions, not just largely from Democrats, but from a lot of people. I watch C-SPAN, for example, which is watching the House of the Senators sort of grilling some of Trump's trade representatives like Jameson Greer. And, it's awful to watch because they never answer the question and they just spout off at them. But the point is that markets could still be more volatile the rest of this year. We're not through it yet. I don't think it's just back to normal. And this uncertainty is what's driving, I suppose, consumer behavior of, do I invest? Do I sell down to cash? Do I change my portfolio?
I just sort of explain to clients it's noise, and the only thing that's different is the source of the noise. And I think dimensional choosing the title "Tune Out the Noise" is so perfect, because it is true.
Isn't it very apt?
Yeah, it's just like just tune out the noise. It's like the expected return on equities is far higher than the expected return on cash. Put the money in the market, sit tight, ignore it. This money here is paying your income. That money's for growth. If you're going to freak out, if you're going to get upset, if the market goes down 10, 15, 20%, then let's maybe phase it in over a period of 4 or 6 months, whatever works for you. Yeah. But my advice, my recommendation, and I say this to clients, they say, should we phase it in? I say, my recommendation is the money goes in straight away. And the reason being is the expected return on equities is higher than cash. You're sitting on the sideline, you're giving up expected return. But if you're going to get upset, if the market goes down 10, 20% in the short term, be it this money's invested for 10 years plus, then phase it in over 6 months if you want to.
Yeah, it's interesting. It's the mindset, isn't it? It's how you look at it. And one of the things that I decided to do this time on, I think it was April the 3rd, I sent out a video to all my clients to try and get on top of it, a short 3-minute video where I was trying to discuss what was happening. And it was almost as if I should have done it the following day, because we had 2 continuous volatile days, the 3rd and the 4th of April. And it wasn't until I think the 9th, I think it was the 8th or 9th, when there was this reprieve and the 90-day that markets suddenly shot back up again. But I remember doing it for when Russia invaded Ukraine and markets were choppy and volatile. I thought, I'm going to communicate with clients. So I was pleased I did that, and I waited a week rather than try and send something every day, and which I think panics people more. You feel like they need to be reading it. Waited a week and then sent another email and put an article on our website and just said, what does it mean for you? This is what's actually going on. And I didn't want to, I spoke to my wife about it, and she said, well, Why explain what's going on with tariffs, with the dates and what happens and what they mean and how they work? If people are reading this in the press, why not just go straight to the practical tips of what you should do and what it means for your money? And I decided to include quite a lengthy article on what the tariffs were and how it works, because I think that a lot of people choose what they want to read and believe what they want to believe. And I was trying to get to the facts. So still a lot of Americans believe that the country that's exporting to America is the one that pays the tariffs. Like China would pay. It's not. It's the importer, of course, that pays the tariffs. The company that's importing pays it, and then they usually increase their prices and pass it on to the consumer. So costs go up, inflation goes up, and so there's no real outcome that I see that's positive about trade tariffs. A lot of data shows in the history of all the tariffs, and I included examples in my article, that there's no real positive outcome. So I just can't understand the logic behind them, besides it being some kind of weird power play from Donald Trump. And
the logic is that he wants to take in more money to pay down the national debt. That's the logic behind it. And I believe he's an exceptionally clever man. I don't necessarily agree.
Do you really?
I do. Yeah, I don't believe you can become a billionaire by being an idiot. He can't get elected for a second term by being a fool. I think he comes across a bit like that. And he is very Marmite in his approach, what he does. But he's bright. He's a bright guy. And I think that the reason the tariffs went in at such a high level is so he could ski down.
I forgot you were half American, so you're not allowed on any visual podcast or ever to say anything negative about the president of the United States. I will tell you that I don't like him at all, and I think he's an idiot.
I didn't say I liked him. I didn't say I liked him. I said he was intelligent. Yeah,
I don't think he's intelligent.
I can. He's bright. He's a bright cookie. I can differ. I can separate my familiarity, my fondness for an individual, from my objective observation of their skills and talents. And I don't believe, my belief system is you can't achieve what he's achieved without being quite smart. He's a shrewd negotiator. And I believe his strategy all along, in hindsight, I didn't believe this. I didn't get this at the time, was to go in high, and then ski down to 10%. I also think that Musk is going to be a scapegoat for him.
Really?
Yeah. So he's putting Musk forward to do all the dirty work for cutting all the expenses. And I was actually with an American government worker this week. And he said it's real. They had unlimited credit card spending. Came in one day, you've got to cut all the spending. So spending limit down to $1. That was it. So they had no all unnecessary. So they are really cutting back.
The risks, though, of cutting back on Social Security and saying it's a Ponzi scheme, getting rid of government workers, the Department of Government Efficiency, canning and so many employees, that the economy itself not only will probably go into recession, and it's all been predicted, but you're taking them back to the Stone Ages. The level of distrust in America now, it seems to me, to be incredibly high. So I was looking at it saying, what's the reason for these tariffs? And we just talked about it there, but you said about paying down the national debt. The national debt in America is 36 trillion, apparently, a huge number. And of that 36 trillion, I think something like 900 billion is debt owned by the Japanese, and a trillion is owned by the Chinese. And I think that he's so bothered about, on the one hand, talking about trying to bring manufacturing jobs back to the States. And there's been all these memes, haven't there, about Americans making Nike shoes and iPhones, which is ridiculous, amusing. Even though I agree that there's a problem, the problem being this trade deficit, this imbalance of where the manufacturing is, it doesn't make any sense to sort of put unilateral tariffs on every country in the world to then somehow try to, devalue the dollar? Are you trying to do that? Is he trying to intentionally raise prices to inflate away the national debt in America? Because the people that voted for him, who he's told, I will reduce prices, you'll have more jobs and the rest of it, it's that they go in the opposite way.
I don't speak with so much certainty as you do, Paul, about it, because I think there are so many variables, and it's such a complex machine that I don't think even predictions are often wrong. I do know that America is too indebted and arguably insolvent. and it can't afford to carry on propping up the likes of NATO. I think it's bizarre that it puts in so much more into NATO, and it's also funding all these charitable projects globally. Now, is it the way he went about it? I don't agree with. So I'm not saying I agree with him, but I do agree. I'm not saying I agree with him in entirety, but I do agree that they can't afford to keep doing that. And therefore, perhaps a bit more notice and say, hey, over the next 2 years, we're going to wind down the amount of money we're going to be supporting here because we can't afford it anymore. We're going to have to start, paying down our own debt.
But what leaves a bad taste in my mouth is there's no clarification of the purpose of it. It's all disguised. It's if the real reason is to devalue the dollar to make it less the world's reserve currency, to pay down debt, to make America stronger in the long term. In the short term, the pain that people will suffer from reduced valuations on their savings, and people losing jobs and immigrants being thrown out of the country and all, it doesn't seem to make sense to me. But I sort of get that he's the doing it like the Wild West, just ripping off the Band-Aid, saying, right, we're just going to do it because no one else has got the balls to do it. Even though there's all of this pain that's happening, we've still got companies with a lot of money. Capitalism still works. Of course it does. Markets will find a way, will adapt, will have levels of resolves and change their where their markets are and adapt over time. So that the point is that all of our clients with investments in their ISAs and their pensions, their savings, albeit there's going to be volatility. We should get back to talking about what that means and the volatility and how to define it. But that long term, everything will be fine. And I agree with you that it's noise. It's just a bit scary to me because, it doesn't sit well with me that Congress can invest based on privileged information and make a ton of money, and it's legal to do it apparently. And it's like having insider information, insider trading. They can do it legally, and the billionaires that are supporting him because they don't, all of the people like Elon Musk and Jeff Bezos, they're all standing around and Zuckerberg, they're all there at his inauguration because they're not prepared to see him as an enemy. And so the levels of integrity seem to have fallen off a cliff. With the big companies, it's all about money, more power.
Yeah.
And the average person is going to pay for it, which is just terribly upsetting.
I don't disagree with that. And I also think it's awful the way that they've just seemed to have dropped the environmental issues and the diversity issues, stuff like that. So
the DI, exactly.
Yeah. So that's there's no backbone. It's like they don't have an opinion. They're just basically following the opinion of the guy in the White House.
Bullying tactics, isn't it?
Yeah.
It's just imagine saying to a big department, if you drop all your budget for diversity, equity, and inclusion, we're just not going to bother with that stuff anymore. If you're not a real American and you're not, got the right visas, we'll throw you in jail, or we'll deport you, or you'll pay a big fine, or all three.
Yeah.
And they're forgetting, because it's been done so quickly and recklessly, that the longer term implications. If there is some grand plan, which I can't believe is true, but if there is a grand plan, it will play out, and we'll find out what happens. But if you're the biggest global superpower and you're 65% of the world's market cap, the world's policeman, the reserve currency, and you just say, right, we're this big, we're now not going to help other people, the little man. We're going to get rid of our foreign aid because we're just tough. We're just going to cut it. We're going to just not live up to our responsibilities.
I'm not sure this is adding any value to a client. Does that make sense? I don't think this.
We're talking about the problem.
Yeah, this is just the noise. This is just the noise that's going on. I think one of the things that you said at the beginning about communicating with clients was essential. We are evangelical about communication. I think it's so essential. I didn't do it so well when I first got in the business. So in the .com bubble, I didn't communicate so well. But in the financial crisis, we did it very, very well. And then the pandemic, we did navigating the corona crisis. And we are now just making sure that we're just sort of saying, hey, look, these are the facts. And I think you were right to include the information that you did about tariffs, explain everything else, because your clients are going to get the information from somewhere. And I want my clients to be reassured to get factual, clear information from us. The news have got the tabloids have got an agenda, and that's to sell newspapers. Our agenda is to make sure our clients are feeling safe and feeling okay. So if they feel that there's a consistent sound message coming that they can rely on, and that's from your firm, then I think you're doing the right thing. So if you're a financial advisor out there thinking, should I bother? The clients get all this stuff on the news. I urge you to reconfirm to your clients your strategy and your process.
Yeah. No. Do you know it's fascinating that I just had a thought yesterday.
That was good. Congratulations.
Thank you. I had a revelation. I tried to have lots of ideas. Anyway, if you read more and you think more and you give yourself the time to think about something, maybe you'll come up with a good idea. So I thought what might be a good idea is to reaffirm why we use Transact. Right? It's our preferred platform. And I'm talking about the difference between perception of something, whether it's the perception of the markets or the tariffs or anything like that, and the client's perception of Transact. Now, I've like to reaffirm things. And if someone's making a good decision, what you do as the advisor is you remind them that what they're doing is correct. And every time you have a meeting, you're reaffirming the investment strategy, the risk profile, and you're telling them the truth, absolute truth and honesty. The idea was to send a document to clients explaining why we use Transact, what the benefits are, how the money's protected, and why we think they're a great platform. Because if people are concerned about markets, rather than, as you said, talk about the issue and get them more worried, I'm trying to go the opposite way and say these are the positive things. You've got in your portfolio usually 7 to 10 funds in our models. There's over 12,000 securities that are equities and individual companies, and there's over 16,000 bond securities in the portfolio. So 28,000 stock and bond securities in the hugely diversified, in low-cost index funds with massively strong companies like Dimension and Vanguard. Reminding them where the money is and how it's protected and how it works, I think is important.
I agree. Yeah, completely. I don't think we're at the level of saying about being protected and stuff. I don't think that's the sort of financial issues at the moment. But just talking about the volatility of the markets and making sure they understand. I think most clients are more worried that, am I going to lose this money? And can I still afford to do my living? Can I still pay my bills and do the things that I want to do? And I think our relatively unique asset allocation approach that we've kind of covered before, I just re-emphasize that to our clients and just sort of reconfirm to clients that, hey, look, this is expected. This is normal market volatility. There's nothing to be concerned about here.
So, volatility, we know, but I'm going to say it anyway. It's a sort of measure of how much an investment's price moves up and down over time. And technically, it's the sort of the standard deviation of returns. Now, probably shouldn't use standard deviation, the term, with clients unless you're going to explain it clearly. But one of the ways that I do it is show them a graph, or do this with my arm and show an upward curve, a trajectory that's normal, and say the deviation is how much it goes up and below, like a wiggly line like this, above the average return.
You draw nice little charts, little wiggly lines, and have different colours.
I've got a graph, I've got a template, I've got a presentation. I don't actually draw it in front of them. It's on a graph, and it shows over time a sort of standard upward curve, an upward trajectory, an arrow going upwards. One of the things I said in my video to my clients is, it's not a guaranteed level of return every year. It's not a standardized, it's not a level line. Markets go up and down, but they go up over time. And there's a big difference, isn't there, between someone's perception of having, 4 or 5 direct stocks in big companies. You can make more money or lose a lot of money. You can theoretically lose all of it if it's in a stock that goes to zero. But when you've got 28,000 stock and bonds in collective funds, it's very, very unlikely. You'd have to have massive amounts of fraud or companies going to, but you'd have to have a nuclear, you just can't lose all your money.
You've got bigger problems. If that happens, you've got bigger problems in life.
You have, yeah. So obviously a more volatile investment will fluctuate more day to day, and less volatile investments move a bit more steadily. So I've had discussions recently with clients where one yesterday, he was previously in 100% equities. He's moved previously to 70-30 model. And we had a chat yesterday, and because he's got time and because he's paying high regular monthly premiums, I said to him, look, you want to talk about risk? Normally, we set your risk profile and you shouldn't change it. You can't be chopping and changing from this to that and altering the asset allocation daily, knee-jerk reaction. But what we did do is conclude that 100% equities for him was the best potential source of return, not just the short term, but the long term, or not just the long term, but the short term as well. So I'm thinking, with all that's going on, there's a benefit in having certain bond funds. There's a total potential that that people might revert to bonds. There might be a sellout of equities if markets are volatile and bonds might do well. We might get reversion to the mean in due course. So if there is a recession, we get falling interest rates in the UK if inflation's under control. And because of that, yields go down and the price of the bonds goes up. So there might be a point where bonds are safer. But if there is this stagflation where you've got high inflation and low growth, bizarrely, it's going to be commodities like oil and gold that are going to do better or historically have done better. And, I'm chatting to him and I basically concluded, look, did the same as you would say, stick with it. Don't alter it too much. Just keep paying in and don't look at it. And that the practical things you can do are exactly that. Tune out the noise, keep the regular payments going, don't look at it very often. And the more you look at it, the more annoyed you're going to get. Whether if it goes up, you'll be like, oh, good. The next day it goes down. You're like, oh, no, this is terrible.
There was some research done in the States. I think it was with Schwab about their clients who viewed their portfolios daily and weekly and annually and stuff like that. It was quite a big study. I have to try and dig it out. And they concluded that the clients who just looked at it annually or less often actually did better overall financially. Their returns were higher than the clients who looked at it more often. It's so counterintuitive though, isn't it? It's like everything in our life, the more we do of it, we tend to get a better result. If we work out more often, do things, we're a bit more active. If we spend more time with our loved ones and talk about people, whatever if we read, we get better educated. But with investment, it's almost the opposite. It's the antithesis. The less we do with it, we stick it in globally diversified index funds, the less we do with it, the better we're going to be. And it's just not a natural instinct for us to do that. But we tell our clients to look at it once a year. We send our investor reports out in December, check the valuations there, and we're pretty confident 3 years out before you're going to be positive.
As my clients have matured, as they get older, as I've been working with them for longer and the average age is getting older, I find that the meetings now are much more about, lifestyle, living your best life, mindset, behavior, talking about health and talking about perspective. It's not just the money or the investments for the sake of it. We talk about having a stoic mindset. And as you know, this is the sort of focusing on what you can control, accepting what you can't, responding to life with a sort of calm, rational intention rather than emotional reaction. I really like the stoic mindset, and I like to include this in templates, in presentations with clients, talk about them, their lives, what they want to do. And I always remember from a selling point of view, you've always been a salesman, used to sell door-to-door, aerial photographs door-to-door, and it's an emotional roller coaster prior to being an advisor 30 years ago. And they'd always say, control what you can. Control what you can control and don't worry about the rest. And that phrase has just stuck with me so long because, you can't control the markets. You can control how you respond to them if you're looking at them. You often can't control people's behavior, but you can control your own actions when if you're selling to someone or you're explaining to someone, you can just steady the ship. I think my clients see me as someone who's trying to reassure them an impartial discussion, that they want a second opinion, they want reaffirmation of what they believe. And if they don't, I'm very clearly going to say to them, no, don't sell down to cash. That's a bad idea. I will disagree with them, but discussing the whole point of living with virtue, with purpose, and accepting reality it is. That's the whole stoic mindset. I just love speaking to clients about that. 90% of the meeting and 10% on the money.
Yeah, and I agree with you. I think that's a combination of your clients being with you for longer, i.e. now you've told them the same message over the years, so they don't need to hear it again. And also I think as we age, we become calmer. At 51, I'm a much calmer investor than I was at 31, although I've got a lot more money at risk. Does that make sense? So I've got a lot more money in the markets, but I'm a lot calmer.
You have, or your clients have?
I do. So at 51 years old, I have a lot more money in the markets than I did at 31, but I'm a lot calmer, which almost is counterintuitive, isn't it? You think you'd be a lot more sort of focused on it and stuff.
Yeah, I know what you mean. I think it's both the maturity and the experience of yourself and the clients that you work with. But I think also, as we get older, successful people tend to build up a resilience because they've dealt with problems in the past, and their mindset is often stronger as they get older, and it's different for everybody. But also, I suspect that a lot of your clients and yourself will have reduced the debt. If you had a mortgage, you tend to reduce it. You get more. You build up your cash reserves. You've got more assets invested, and your view of them changes over time. And I think that what for me to give practical tips to the clients I work with. I did this in the email and on the article on our website, which I'll put a link to. But I sort of say, look, you've got to top up your cash. You've got to control what your budget is. You've got to think about, do I need to be a bit more frugal this month if markets are choppy, or if I'm thinking about it too much, or if I'm withdrawing monies from my portfolio at 4.5%, should I slightly reduce that? These are practical things you can do to weather the storm if you're bothered about the volatility. And you have to be sensible about it. You can't just continuously, if you're invested in 100% equities, make no amendments whatsoever. There's lots of great white papers by Vanguard on this very point, talking about making slight amendments, living off cash for a bit, reducing the withdrawal rates, changing your spending habits. Those can make a big difference in the long term.
Yeah. So, our clients spend cash in bonds; they don't spend equities. But I've not spoken to existing clients about reducing their spending or making changes in this current situation, because we've got 5 years of buffer there to cover their expenditure needs. However, a new client going in, I would be pitching their income level at a slightly lower level at the moment, because they're going to put some of that equity into bonds. They're going to draw off that. So because they're going through that transition period, I would be more mindful to put them into a lower, more conservative rate. But existing clients, I think setting their drawdown rate up properly on day one kind of allows them to weather. Hey, we've just had a few weeks of extreme market volatility and stuff like that. This time's going to pass, and it's not different. Trump's, I think we can all agree, Trump's ego is very, very big. And I don't believe he's going to want to go down in history as the president who destroyed the American economy.
Well, you can bet your bottom dollar that this is what I think will happen, that the markets will continue to be volatile, the economy will shrink a bit in the US, and then there'll be some massive change, whether he's forced to do it or he does it himself, and then things will recover, and then he'll say it's the greatest recovery since of any president of any time, and it's the biggest increase, and then he'll ignore all the nonsense that he caused. It was like when he changed the trade deal with Canada. Did you see that? And it said in 2018, he said, "Who on earth that came up with this deal? Who negotiated this deal?" And then they pan back to a YouTube clip of him in 2018 signing the deal with Canada. And it was him who did it, and he's then saying, and people have forgotten, but the press doesn't forget anything. They sort of look to it and say, well, who is this idiot who did it? So there's this perception, go back to volatility and this perception that when markets are volatile, if clients look at it, and you train them not to look at it, but if they look at it, people feel bad because the value's dropping. And the media hypes up all of the swings and says, oh, it's a disaster, markets have fallen to this, and this much has been wiped off. And we know it's all temporary and volatile's par for the course. But what I wanted to talk about is how clients perceive volatility as risk, whereas the real risk is not being invested. The real risk is sort of selling out to cash or making knee-jerk reactions. The real risks are things like behavioural risk, inflation risk, shortfall risk. These are the real risk in my view. If you've got a well-diversified portfolio, the biggest risk is human behaviour, isn't it?
Oh, yeah.
Or one of the biggest risks of saying, should I change my portfolio? No. Just leave it. Should I stop paying in? No, keep paying in. And I have had a very few discussions, thankfully, with clients recently. Of all the clients we manage, there's been probably less than half a dozen that have sent emails or calls being concerned because they now know this is what we do and how we do it. But you do get the odd client that's got money invested. They've decided they need money for £20,000 for a car, for example, and they happen to not have enough in cash. And I think, is this because I didn't tell them? Because we didn't have a meeting? Because they've spent it all? It's a combination of reasons. But I'm then saying to them, probably not a great time to draw it out to some of them. And others, okay, we'll draw it because in the last year, you're still up positive, even though it's fallen recently. And you have this discussion. And it's the reality check that I think that I like to have with clients and always ask them, okay, how much are we spending? What do we need? What cash have you actually got at the moment? And let's just make a sensible decision together on, changes if there are going to be any. To your models.
And you know what? Clients often can spend a lot more than we expect. Creating a cash flow over time. We're normally trying to encourage our clients to enjoy their money a bit more, because we know from history. Been doing this 30 years now. We know that clients tend to spend less money as they age. The only thing that they're really going to increase their spending is care fees, and quite often they've got a property that's going to help them cover that through the period anyway. So, I've not told a single client to not go on a holiday or not do anything that they don't want to enjoy and stuff like that, just because some guy in the White House is making crazy decisions.
It's. I think you've got to be the voice of reason, though, and I think that some of our clients, absolutely, because we've got a good working relationship, a trusting relationship. They with most of them, I would say for sure, 99%. They might ask for a permission to draw their money out of the portfolio, or say, is it a good time to do it, or should we do this? If they're in drawdown anyway, if they're in decumulation, both terrible words when you're talking about, if they're drawing their money, if they're in retirement or whatever, there's usually 6 to 12 months of cash. And that's the way we do it. We set aside 6 or 12 months of cash, and that's where it comes from. So in the short term, which is 1 or 2 weeks or 1 or 2 months, it doesn't matter if equity markets or bond markets fall, because they've got the cash, which is retaining its value largely, insofar as it's not dipping in value. And one of the things I say to them at the moment is, there are multiple benefits of having your cash on Transact. Number one, you get 4.28% gross return. That's good. Interest is paid monthly. They spread it between 7 different financial institutions. They don't skim on cash. If you want your money and it's a large amount, I can get it to you directly within 24 hours, usually on the same day, for no telegraphic transfer fee. And the fourth, which I like the most, is it's this barrier. If the client's got 100, 200 grand on cash on the platform, it's this barrier to them having to ask us for it. Because sometimes you've got clients where it's in their bank and they'll go and spend it. And I'm not saying all the clients just spend whatever they want. It's their money. They can do whatever they want. But, if they need to at least ask for it. And is it a good idea? And I think that's a positive thing.
Hey, do you know what? Our income portfolio is up over 6% in the last 12 months, and our equity portfolio is up as well. Not 6%, but it's still positive. So, hey, do you know what? This time is just going to pass like every other. I think the key is to, like you've said, manage your clients' emotions, keep them in their seat, keep them investing. And if you run a cash flow and you do a market correction and people are saving in regularly, you'll often find that they'll do better in times like this, because the markets pull back, they can buy at a cheaper price. Anything else you want to raise on volatility and Trump's tariffs and such like?
Well, honest to God, I could probably talk for a long time about Trump's tariffs, but I don't want to. I think we're already 50 minutes in or so. What I'd like to do is to go on to quotes and anecdotes, but instead of an anecdote, I wanted to give an analogy about volatility, if I may.
Go ahead. Should we do a quote first, or do you want to do that? We want to do quotes first. Have you got a quote today?
So you want to do quotes first? Okay, yeah, I've got a couple of quotes. So I'll choose 2 out of the 5 that I've got and see what we've come up with. So first one's from Benjamin Graham. The investor's chief problem, and even his worst enemy, is likely to be himself. Yeah,
definitely 100% behind that. Completely.
All about the behavior there. And what else is a good one? So Howard Marks said, volatility is not the same as risk. Volatility is the price you pay for the possibility of superior returns.
Okay. I do like that's a good quote. And it's almost similar to my one, which is an unknown author, which is volatility is the price you pay for performance. Without it, there'd be no reward. And although it's not attributed to him, I thought that's really good. I quite like that one. And
I think you could use that sort of a quote because you say that every 3 and 4 years are positive, and then you also say that market swings you should expect that from peak to trough there to be like 50%. If you're an equity investor, there could be 50% decline from peak to trough. And if the clients, there's one here from Charlie Munger, who's was 99, I think, when he died. He was the sort of best friend of Warren Buffett, wasn't he? But he's actually said, if you're not willing to react with equanimity to a market price decline of 50%, 2 or 3 times a century, you're not fit to be a common shareholder. So if you said to your client, look, this is just the price of admission. If you don't want volatility, don't invest, and then suffer the poor returns of cash and inflation eroding your money. The only way to maintain, one of the main ways to maintain the buying power of your money is to buy stocks. It's to buy stocks and shares, is to buy equities. in a well-diversified portfolio. The end.
And this is the quote that I often use with my clients. The stock market is a device for transferring money from the impatient to the patient. And
surely that was Warren Buffett.
It is.
Surely that was Buffett who said that.
It is. Yeah. And when you use that quote from Buffett, it kind of carries a little bit of weight. So, come on, tell me your analogy. What's your analogy you got?
So my analogy is to do with volatility and a long haul flight. So volatility is like turbulence on a long haul flight. So you got to imagine you're 30,000 feet in the air. Your seatbelt sign comes on. The plane starts to sort of bump and rattle, and maybe your coffee spills, and maybe your heart skips a beat. And this is volatility. It's uncomfortable. It's even unsettling at times, but it's entirely expected because you're traveling long distance and you're going through different climates and airspaces. What do? You don't storm the cockpit. You don't grab your parachute. You don't demand to be let off mid-flight because you know that turbulence when you're flying is just part of flying. And just like that, volatility is part of investing. It doesn't mean the engines have failed. It doesn't mean the wings are falling off. It doesn't mean the pilot doesn't know what they're doing. The real risk isn't the shaking. The real risk is panicking and jumping out of the plane mid-air, selling everything in a panic, moving to cash, making big decisions during temporary discomfort. That's what can derail your journey. So instead, stay in your seat. You trust the pilot, that's your plan, the crew, your advisor, and the flight path, your strategy, and you maybe grip the armrest a little bit tighter, but you keep going. And over time, you descend smoothly into your destination, often wondering what all the fuss was about.
Yeah, I like that. And to be fair, I had a very, very similar one, but the roller coaster. So you could swap the analogy of a plane for a roller coaster. Same thing. I like the plane in fairness.
Completely.
That's it. Yeah.
Yeah. So I might actually push that analogy through social media because obviously I wrote it, I sourced it, I sort of had a bit of help with it, but.
Do you maybe cull it down a little bit? Just cull a few of the words. I don't know.
Yeah. I'll cull a few words. But I think we talked about both those things a little bit there in a bit of detail, Trump and volatility, and it's hugely topical. I think that people are listening to this. Hopefully they're taking some use from that and some benefit from that and some top tips. But if you do have any questions, let us know and put them in the comments. Brilliant. Warren, are you going to sign us off?
Hey, that's a wrap for today. Thank you. Please leave your questions in the comment section. Let us know with anything you'd like us to cover in future topics. Thanks for tuning into the Finance Geeks podcast. That's it for today's session, and we'll be back in a couple of weeks. Thank you.
Thank you very much. See you now. Bye.
Thanks for tuning in to the Finance Geeks. Don't forget to like, subscribe, and leave us a 5-star review. Drop your comments and questions on YouTube, and be sure to follow us on social media. Join us next time for more insights to boost your financial planning game.